Welcome. You're viewing the video version of the Pirls Stock Market Commentary featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart for February 21st, 2016. Market breadth. With this past week's market decline, our Bull Bear Point and Figure ratio at 0.74 rose from 0.28 last week and continues in bearish territory. The total count of securities in bullish or bearish patterns fell 15% to 2,842. The count of bearish stocks decreased 37%, while the count of stocks in bullish patterns increased 66%. The Pirls P&F Market Breadth Summary Chart shows us a market now 37 consecutive weeks in bearish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the Pirls Stock Market Commentary free of charge via email, simply enter your email address in the space provided. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 180 points for the 15th advance in 25 weeks. At a negative 832.90 points, it continues below all 7 tops above plus 100, has risen above the August 2015 bottom, the recent February 2016 bottom, and continues below the 4 remaining bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 3 accumulation days and 2 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on higher average daily volume. Momentum. At Tuesday, February 2nd close, the CCI 20 daily formed a zero-line reject short entry signal within the plus or minus 50 range. The CCI 20 daily moved upward at Thursday, February 4th close, but we stayed in the trade since it did not rise above the zero-line reject pivot point. At Friday, February 12th close, the CCI 20 rose above minus 100, so we exit the trade at the next market open, Tuesday, February 16th. The result of this trade simulation was a gain of 145.87 points on the Nasdaq Composite, or $3.36 per share of QQQ. At Wednesday, February 17 close, the CCI 20 daily rose above zero and continued above zero for the remainder of the week. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 1 week ago, while the daily CCI 20 began a Woody's downtrend 9 weeks ago. At Friday, February 12th close, the CCI 20 weekly had 6 consecutive weeks below zero for a change in Woody's trend to down. It rose last week to minus 103.31, outside the plus or minus 50 range for a valid zero-line reject short entry signal. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 industries are negative. Bullish, networkers has entered the top 5. S&P retail and semis have left the bottom 5 and entered the top 5. Brokers has left the bottom 5. Bearish, gold and silver continues in the top 5. KBW Bank has entered the bottom 5. Focus this week from Charles Hugh Smith's of Two Minds blog. Think another crash is impossible? Think again. The following are some key points. The confidence that risk can be quantified and mitigated is misplaced. Lou G. There is a trade-off of importance, detail, and distance into the future, sort of a Heisenberg's uncertainty principle. The cost of certainty and detail at any future time goes up as the economic importance goes up, because so many more people are trying to understand and control that small part of the future. This introduces more variables and more uncertainty, because many of those variables will be linked in unknown ways. Lou G. One would expect that a bank's internal risk analysis programs will try to do some of this, but they can only know the bank's point of view, not the exposure of any other financial nodes in the network, or the fantasy level of their accounting. But if Lou is right about a Heisenberg analog in finance, this suggests the greater the certainty in the forecast, the less precisely the risks can be accurately estimated. Given the concentration of talent seeking certainty in a narrow slice of financial data, the potential for groupthink, both in humans and in the software written by humans, is another potential source of risk. If the linkages between variables and nodes are incompletely known or understood, disruptive cascades can arise in areas thought to be low risk. As the cascade spreads through the network, it starts taking out nodes that participants suddenly discover are connected in unexpected ways to other nodes that were considered only lightly connected to risky nodes. In a Heisenberg analog network, risk can never be nailed down with any certainty. A system riddled with various forms of misinformation and links that are not apparent until the cascade has begun is intrinsically prone to crashes that take down every node in the network. This is not impossible. It is an excellent description of what happened in 2008 and 9. Thank you for tuning in for this week's Sand to Pirls Stock Market Commentary video featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a productive and prosperous week coming up, and wishing you true success.